G'day, my name is Nick Samios. I am the Director and Fund Manager here at Hermes Capital, and I am your host for the live stream that we call Lunch Money. We're back for 2022. We've got a couple of fabulous guests. We're going to be talking about the consequences of Probuild. Lunch Money is your home for special situations, workouts, and capital raising professionals. Cue the intro. Okay, we had the collapse of Probuild last week. It was a big event. They're a very large company with lots of subbies around town who are taking hits. I heard someone tell me this morning that they were talking to someone who was owed $10 million. I've certainly got a couple of files that I'm working on where Probuild are in the debtors ledgers. So it's a big story. Some people are saying it's the big event that's going to put the insolvency practitioners back in business, but we've heard that all before. I've got two people who are going to help me talk about Probuild and insolvency and the Security of Payments Act and subcontractors thrown under the bus. What's happened and how can they perhaps avoid it next time? My first guest is Mark Robinson, and Mark Robinson is with De Vries Thayer, DVT Group, and my other guest is Mark Young, who's the property specialist at ERA Legal. And I'm going to start off by introducing you to Mark Robinson. G'day, Mark. How are you going?
Good, thanks. Really well.
Fantastic. Now, when this Probuild matter first hit the papers, I was very opportunistic and I shared it on LinkedIn. You made the comment about risk. You were talking about the location of risk with subcontractors. My immediate comment was, I think, talking about how you go about selling a business in this industry that is insolvent. But the conversation got a little bit around risk. So to start off with, we've had a large company. It's got some major sites around the country, and we're not talking about residential homes. We're talking about office towers where there's the contract sums are huge, and we do have this issue of risk. So just talk us through what you mean by risk in this contracting scenario.
Well, what I mean by risk is that in the current environment, builders are forced to take on a lot of risk to be competitive in the contracting scenario. If you look, for example, at Lend-Lease's most recent available public accounts, they're looking at a margin of just 2 to 3% on their major projects, and so it doesn't. When you're looking at the transfer of risk, which is essentially done on a fixed sum basis. It doesn't take much uplift in material costs and labour, and then maybe overlay that with maybe one of your major projects having some technical difficulties and soaking up more funds in that regard. Doesn't take much to chew through that margin and actually be into a significant loss position. So that's the risk at the builder or head contractor end. The builders are highly aware of that risk, and so they try their best to pass the risk downstream to their subcontractors, and subcontractors in turn try and push that downstream as much as they can. But fundamentally, we've got a system that's built around very razor thin margins, that's pressing up against a significant rise in costs in a fixed sum contract environment.
Okay, so really, when if you were to go the other way around, starting, the person who supplies the timber and supplies the steel and the other materials, those costs have been priced into the subcontractor's contract, and that's presumably a fixed price contract because the person that they're contracting to wants to know how much, wants to keep a lid on the costs because they in turn have tendered on a certain price, and it all works at that price. But of course, we're now in an inflationary environment, so I guess the risks are even bigger. If you're talking about the guy at the top's pricing on a 2 or 3% margin, and sometimes these contracts can be worth hundreds of millions of dollars. So they're pricing at those margins. It doesn't take, we're talking about inflation could potentially be 10% when it comes to building products.
Yes, and that might lead to, in inflationary times, is it better, maybe, and I might leap to a couple of potential solutions there. I think there's also a problem around inadequate scoping of these major projects to identify where those price risks might be and what their financial impact is. But, there might be a better sharing of risk, whilst I don't think it ever going back to a cost-plus style model. Nonetheless, I think there needs to be a better meeting of the minds between developers and builders and downstream to subcontractors as to what is fair to be fixed on and what is also fair to share, risk in terms of price inflation that is out of the hands of the contractor.
Now, you've seen your fair share of insolvencies, obviously, and you've worked on insolvencies in the construction industry. So, and every time you've got to write a report to try and explain to the creditors what went wrong. So is that a common feature?
Oh, look, I think essentially very sharp pricing, sometimes underquoting, but even if it's not underquoted, there has been blowouts either due to poor management, which is led to rework that has to be done, and also poor scoping in terms of really identifying what expertise is required to do the job, and quite often particularly contractors and small builders are trying to work their way up the stream from tier 4 to tier 3 to tier 2, and they're quite often doing it with very thin balance sheets, and so they really can't take a knock on contracts with such slim margins.
Okay. All right, Mark. Well, look, we're just going to pop you back in the waiting room and we'll introduce our other guest and let's see where he picks up where you left off. Just one moment. And we're bringing in Mark Young. G'day, Mark. How are you?
G'day, Nick. I'm well. Thanks for having me on.
Fantastic. Now, Mark, just if you could just quickly explain your role. You're in the property space, obviously. So who are your clientele and what's the most common thing that crosses your desk? What are people coming to you for?
So I mostly do work, Nick, for builders, developers, and some larger subbies. So the types of things that I'm seeing across my desk lately, last quarter, which is good. I think it's a reflection of the economy picking back up again, is a lot of new contracts. So not as many disputes, but like new head contracts being signed up, which shows me that there's lots of projects in the wings and coming along. That's good to see because prior to that there wasn't very many of those. I also get a fair chunk, as you probably aren't surprised by, disputes about payments, and a lot of it comes down to the contractual risk that people are taking on. So Mark Robinson.
Yeah.
Well, Mark just firstly talked about it.
Yeah. So firstly, I just wanted to say that people that watch Lunch Money are certainly used to me having insolvency lawyers on. But just to be very clear, you're a property guy, so you're coming from that perspective. So you've got the hands-on. It's not something that you do sometimes. It's something that you do all the time. So yeah, just pick up on some of those points that Mark made.
Yeah, Mark Robinson's spot on about the contractual risk. All of this really comes down to what is in your contract, because that dictates what your risk profile will be for any particular project. So, if someone excludes the subterranean risk and all of the in-ground risk is then shifted across to somebody else, well, then happy days for the person who's done that, because what it means is that's not a risk that someone's going to be sitting there and stuck with. What I see.
Sorry, can you just in 1 minute, can you just sort of tease out what you just said then, the subterranean risk and all of that?
Yeah, so it's a good example of where a builder, it's always a risk that a builder takes a close look at. It's where there can be a lot of latent conditions, and that's whatever you find in the ground. So when a builder is going and pricing a job, they'll have geotechnical engineering reports. They'll know generally the composition of what's in the ground, whether it's clay, rock, soil, sand, whatever. But they can't know for sure until they start excavating for the foundations or basements or whatever it is that they're doing. So it's always a big risk area, and it's a bit of an unknown. Drilling down into those areas is critical, and understanding how to make those risks back to back for a builder with somebody who ultimately will be insured somewhere along the way, whether it's a geotechnical engineer, whether it's a structural engineer, hydraulic engineer, whoever it is, and also obviously the people who are doing the work, and making it all seamlessly work together is something that is very frequently not done very well.
Okay, and then, so I'd just like to remind people watching or listening live that if you're watching us on LinkedIn or YouTube or on Facebook, they're all we're streaming to all of those. You can post a comment or ask a question, and I'm sure either of our two Marks today would be happy to take them on. Now, getting back specifically to what Mark Robinson was saying about the risk in terms of fixed costs. The big guys are tendering for these major jobs. They might have a 2 or 3% margin in them. I guess your guys are the people who are maybe subcontracting in some scenarios to the big guys. And then, so what are the things that they're talking to you about for them to try and manage that pricing risk, where they've got fixed price contracts, and we've got, as we said before, we're in an inflationary environment. Your materials can suddenly cost more. You've also got this COVID scenario where sometimes you don't have people turning up. But firstly, in terms of fixed prices and changing prices, and then I'd like to come back to you about delays and those sorts of things.
So the starting point for the building industry is that risk is getting passed down, and where you're talking about a Probuild type builder of tier 1, tier 2 size, they're normally dictating terms to their subbies, and it's not always on a take it or leave it basis, but it's pretty close to being that. So subbies don't really get a great deal of autonomy in deciding what their risk is going to be. It's kind of, well, this project is going to involve this degree of risk, and if the subby at least does the minimum, which is understand what that risk is, then they understand what they need to pass through.
And tell me, I'm just trying to find a comment that I had here on LinkedIn. I've lost it now, but it was one of the team from. Let me just find it now. But what they were saying is, these problems happen where the subcontractors are wearing all the pricing risk. Is there any chance that in the future we see a scenario where people are saying, look, we need a certain quality. We're not asking you to tender to price, but we're asking you to tender on a service basis as to the service that you're providing, because tendering on the price of risk just puts too much financial risk into the project. Or is that is that never going to happen?
It could happen, Nick. So I guess it really depends on the job, because generally speaking, each project will have its own risk profile, like top down. So example, a school project, time is pretty important, because the government or whoever it is that's the proponent of the development is going to want to make sure the school's delivered for first term, or whatever they've committed to the parents who are going to be the old end user of this product. So time is important, and probably scope not so much, and the cost is probably not that important in comparison to the competing risk areas. But a boarding house, for example, not so. Like, cost is the most important thing. Time's pretty important, and scope, the developer doesn't really care for a boarding house, really. Difference again, if you're building a luxury $18 million house for somebody at Point Piper, they're not likely to care that much about the cost of things. They just want to make sure they get their mosaic wall feature or whatever it is that they're building. So there's some pretty extreme examples, Nick, of what the risk profiles might look like, and when there might be a chance to include, like, push or play around with some of those risk profiles. It really is going to be dictated by that.
I've actually found this comment here. It was from Joe Buchanan, who's the CEO at Castaway Forecasting, and we've had Michael Ford, who is the founder of Castaway Forecasting, on our podcast before, and it was always fantastic and very interesting to listen to. Yeah, they've talked about scoping and promises, and I guess you've sort of covered a little bit of it, Lo. I dare say that Joe would have more questions to ask. If you're listening, Joe, then fire away. Okay, so I just want to move on a little bit. I'm going to bring Mark back, and I wanted to get on to the Security of Payments Act. Now, supposedly we've got the Security of Payments Act, and it is to protect subcontractors, I guess, and to also arguably protect contractors as well, but mainly it came about to protect subcontractors. I mean, what role does the Security of Payments Act have in this sort of scenario, Mark? Yeah, Mark Young.
Yeah, it's there to provide a means, quick and cheap, to recover your money. You can get effectively what you could otherwise get in court done in about 3 months all up, when you wash it all up, as opposed to between 12 to 18 months. It's a pay now, fight later basis.
Now you're a Security of Payments expert. Can I call you that? Is that okay?
If you must.
Yeah. Okay. This is one thing that people keep asking me about. I mean, Hermes has been going for 12 years, and I get it time and time again. Where in the Security of Payments Act does it say anything about protecting the financier to the subby? It's a trick question, of course. It doesn't. There's nothing in the security. Am I right?
Yeah, that's right.
Yeah, there's nothing in the Security of Payments Act, and there are a lot of people who who lend to subbies on the basis of the Security of Payments Act. But let me tell you, there's no relief there. Mark Robinson, the Security of Payments Act. By the time you get there as an administrator, sometimes it's you've lost all the ability to claim under that. But sometimes you get called in to advise to try and avoid insolvency. Have you had any experience with making claims under the Security of Payments Act as a restructuring guy?
Yes, but on both sides, making them, but it's always just a cash flow issue. It's a timing issue, and so you've still got to justify that the work's been done at the end of the day, in terms of settling up, the claim you've made under the. So it's not free money at all. You've got to actually show that the service and the building works have been done. I guess stepping back a bit, I think probably an equally effective strategy for subbies to protect themselves further down the track in an insolvency environment is to use the PPSR regime in terms of the resources that the owners or the principals of the subcontractor have utilised in the business, and try and elevate themselves up the priority list such that they can have more say in and around the restructure of their business should it become. So
just tell us how does that work in practice?
The earlier it's done, the better, and it should be business as usual sort of approach. But as is ordinarily the case for subcontractors, the principal of the shareholders, stroke directors, are quite often the same people, are putting funds and supporting the subcontractor. When they put funds in, they should make sure it's done on a secured basis.
Yes.
But similarly, if advisors to that subcontractor are putting in services, they should also consider utilising the PPSR regime to secure what they're owed as well. Again, with a view, if down the track there is a restructuring required, it's a bit like insurance, if you like, that they can secure payment of their fees, but also, more importantly, they can assist their client, the subcontractor, to be another vote in terms of a secured creditor to help a restructure if one's required to assist the subcontractor to fight another day.
Okay, now I want to just show a article here. Probuild Collapse, owner at WBHO would have pulled the plug earlier. Now, I just wanted to sort of a bit of a change of pace here. I've got a number of questions around this. Firstly, with respect to pulling the plug earlier, I wonder why they didn't. Now, we can speculate, but certainly in insolvency and restructuring circles, we've been talking for some time about all the JobKeeper, the government support, the bank forbearances and loan deferrals and all that sort of thing. There's a lot of cheap capital floating around. I don't know why they didn't pull the plug earlier, but I just wonder how many businesses in the construction industry, up and down the subby stack, if you like, maybe could have pulled the plug earlier, but plug pulling is imminent. What do you think, Mark Robertson?
Well, sometimes if you know you're in a hole, a cash flow hole, even pulling the plug early, you might be able to get out of the hole. So there's the temptation to plug on further in terms of trying to find the solution to get out of the hole. And so it sort of feeds on itself. I've got to say WBHO has probably made that pronouncement with the benefit of hindsight. So, more often than not in business, as the facts of the matter come out after the event, it is easy to opine as to what you could have done or should have done, but actually didn't do. But yeah, look, I think what I quite often see is if there's a cash flow hole of a certain size, call it X, and they can't see their way to get out of it except by going further and trying to solve either the technical problem or renegotiate compromise claims, they'll continue to go further into the contract and continue working, which if it doesn't work out at the end of the day, they might owe 2X rather than X if they stopped early.
And Mark Yum, you get involved in collections as well. You were saying chasing money. So in a scenario like this Probuild scenario, where you see that kind of a headline, where they're saying, they could have pulled the plug a lot earlier. I mean, is that something that from your customer's point of view, I guess the subcontractors that you're acting for trying to chase some money, that must be very frustrating. What sort of feedback do you get on that?
Yeah, it can be frustrating, Nick. I guess there's too many different things. I mean, like I always, when asked that question, say, what if we could have done this differently? It's kind of like, there's no point in trying to speculate in how to fix that, or you can deal with what's in front of you. So, I mean, like there's still things that could have been done up until, while a company like Probuild is experiencing those financial difficulties. And I just wanted to touch on and give you some numbers about the Security of Payment Act, because that's really, a subby or a builder comes to me and says, I need to recover some money. It's the first thing you say. It's the greatest tool in your tool belt, which is use the Security of Payment Act. But there's some pretty interesting numbers. The Department of Fair Trading publish figures every quarter. The latest quarter published is the first quarter for this year. In 3 months, 229 applications for the Security of Payments Act were made for a total of $330 million. 72% of those were made by subbies. Out of those 229 applications, only 50% of them were determined and released. And out of those 50% that were determined released, only 19% of the value of the claimed amounts was awarded.
Wow. So what does that tell you? Does that tell you that people aren't getting their paperwork right, or the system doesn't work, or what does it tell you?
It tells me a few things. The paperwork and the understanding of the use of the Act is very poorly done by subcontractors. And so often we get, and you guys must see the same thing in your lines of work, people coming and saying, oh, look, I've got this claim here, it's great, like, can I get some help with it? But there's not just, submitting the claim is sort of like the last step you get to. You've got to have your variation proposals in on time. You've got to have your EOT claims with delayed damages claims in on time. And very frequently, those are the things that are done poorly by subcontractors. They just either don't have the resources available to administer contracts that they sign up to, or they do and they just don't do it in accordance with the contract. And the moment you don't do those things in accordance with the contract, you're immediately on the wrong side of it.
Okay, and Mark Robinson, you were saying before, you didn't say it directly, but I just sort of gleaned from something you were saying before. You've acted on the other side, where you're on the other side of these security of payments claims. Is that right?
Yes. That's correct. Yeah.
Yeah. And do those stats that Mark Yum just said, do they surprise you, or what do you read into that?
Not at all. That's the first thing an insolvency practitioner appointed to a head contractor would be looking at in terms of any Security of Payment Act claims made on the head contractor is the claim made pursuant to the contract and also pursuant to the Act. And more often than not, there are holes there. So because our motivation when appointed to a head contractor is to preserve cash flow, and so so that's what we look at.
Okay, now we've got Chris Condon asked a question. I'm not sure who's best to answer this. He says, "Hey Nick, what about project bank accounts? Does that have a place to improve certainty?" Who wants to tackle that question?
Well, I guess there's some talk about that because I think in Queensland, and Mark can correct me if I'm wrong, I think the QBCC would be the statutory authority probably looking at implementing that. I think there's some new legislation which is all about ring fencing money on a project by project basis, which sounds good in theory. My concern is when a head contractor, particularly and big subcontractors, are working on such tight margins, there's not an ability to have a central treasury function to move, which they currently use the money for. Funds in from project C might temporarily plug a hole in project A, and so I'll be unable to do that. So what that will mean is that the implementation, I think, will require head contractors in particular to have a lot bigger balance sheet to be able to plug the holes, the cash flow holes in their projects.
Right.
Mark, the only other thing I'd add to that is I couldn't agree with you more, Mark, about the balance sheets needing to be boosted. But the only other answer I can see to that is by having the project financiers and the developers also tipping into the bucket earlier on in the piece, and it being a more like project alliance type model as opposed to master servant, which it currently is the flavour of the month, or has been for the decade.
Yeah, I guess we've already got retentions to contend with, so it's probably not too far away from that type of scenario. But anyway, Chris, thank you very much for watching, and thank you very much for your question. Now, so just getting back to this other article that the headline that we just had. When I shared this on LinkedIn, the Probuild Collapse, John Winter made a comment about certain subcontractors talking down the prospects of the sale of the business, and I think Mark Robertson, you agreed that perhaps some partners are talking down the prospects of the sale. Now it's very hard to sell a construction business that's in insolvency, isn't it? I mean, how do you go about that, Mark? Have you done that?
Yes, I have. From an insolvency practitioner's perspective, to minimise their risk, because that's the problem when we step into that environment, we assume a lot of this construction risk. In an ideal world, we'd like to call a stop to everything and run the quantity surveyors over everything and work out exactly what the state of the building is and what everybody is owed, and then also to flush out who are the key trades that are certifying trades that we need to keep sweet by paying their pre-appointment debts versus those that are just general suppliers that we can find alternate supply. I guess so, but the reality is, you stop a building site for a period of time, even a short period of time, you start elevating the level of risk. And so, it is the ones where I've had a lot better chance of success is going in with a financier who, is well skilled, understands the risks, and is willing to take a bit of a punch at list initially to assume some of those risks to keep contractors on board and at least ticking over, albeit in a slower state, until such time as we can determine where all the stakeholders actually sit. So yes, stopping a site, the problem is also you're going to be danger of all the contracts either being terminated and then all of the various security arrangements such as bonds and guarantees being called up. So if you've got any ability to continue, albeit in a reduced fashion with financier support, that's the best way to go.
Frank Lopalato, thanks for watching, Frank. Makes the comment, really need to support, that you really need the support of the secured creditors, obviously, to keep trading on. And that's very true as well, obviously, because the secured creditors have to, particularly for projects half built, the secured creditors have to make a decision. It's interesting, when the company goes into administration, very often the subcontractors are basically taking anything that's not bolted down because they think they're not going to get paid. And a lot of stuff just disappears off the site straight away, doesn't it?
Well, yeah, and that's the role of an insolvency practitioner, is to lock down the site as quickly as possible. Invariably also, you'll probably be speaking to a representative of the CFMEU who will act as a collective agent for not just the members of the CFMEU but also all the subcontractors, because they provide a service in that regard as well. And then we'll start negotiations about old debt, in terms of what portion of old debt do you need to pay in order to open up the site and continue going forward.
Okay, now I've got another question here from Adam Lyle. Thank you very much for watching, Adam, and it was good to hear from you the other day and see your comment on LinkedIn. Adam says, "Hey Nick, I'm interested in the views of both marks around the notion that larger head contractors are holding off taking any action because they were able to hide behind the government's insolvent trading moratorium. Will we see more activity in the safe harbour area?" And I think that's a good question around safe harbour and whether or not it has a role to play in these sorts of scenarios. So I'll go back to you, Mark Robinson, then I'll come to you, Mark Yum.
Oh, look, I think large building contracts and even medium to small size ones are fertile field for safe harbour, well handled. But again, getting to Frank Lopalato's insightful comment, that will only proceed through to success with the support of secured lenders and financiers generally. Okay,
now Mark Yum, Adam's got a follow-up question there. This is more targeted at you. The Security of Payments Act, does Mark Yum believe that the Security of Payments Act could be strengthened now, given the fallout of Probuild Collapse and the loan numbers he was referring to earlier? So those stats that you trotted out earlier, Mark, you'd think that someone was lobbying on that to try and get better outcomes. How do you respond to Adam Lyle there?
Yeah, I think it might not be a matter of strengthening the Security of Payment Act, but more so educating industry along the way. So I think that is a real shortfall, and somewhere that there's a real area where the industry could improve itself. The Security of Payment Act is a really potent tool already. It already allows subcontractors to do a lot of things, but I mean, like the things that subbies get wrong, they serve the payment claim to the wrong entity, or they do more than one in a month and they're not allowed to. So these are things that are more around education, I think, and for subbies to get that right.
I agree with that, and to their credit, whilst it might have been a bit harsh on that Subbies United commentary around Probuild, that is very effective self-help amongst subcontractors, and Subbies United is very much in and around trying to equip the subcontractors to have effective claims, such as SOPA claims. So there is evidence of organisations out there trying to lift subcontractors' game.
Okay, now we had a really lively discussion around when I did post that article on LinkedIn, and I asked the question about credit insurance, and we've all got a few good credit insurers in our networks, and they'd made the comment that apparently Probuild was covered right up until the day of the collapse. So if you had credit insurance, then presumably you were covered for the event of insolvency. So there might be a little bit of a lesson around that, and maybe sometime soon I might get a credit insurance person on to, because sometimes cover comes and goes. You can't get the cover. So it's one thing to have had the cover, and I'd be really interested to know how credit insurers are covering the market at the moment. If there's anyone watching, maybe you'd like to post a comment. Now, I wanted to get to the latest news on Probuild, and that is that a number of Probuild's major projects are set to be taken over by different builders, with an announcement about the fate of the collapsed builders' jobs expected as early as Monday. So no single builder was likely to take over all the projects of the commercial construction giant, which went into administration last month, and potential buyers have been scrutinising the risk profile of each of the 18 projects. So I guess that's, it's going to be a matter of different competitors at Probuild have got different areas where they've got expertise, and they're willing to maybe bite, to cherry pick, I suppose. I guess there'll be some projects that were really underwater that don't get picked up at all. What are your thoughts there, Mark? I guess the darkest fears of John Winter didn't quite come to pass.
Even the bad projects will have to be, and I guess Mark Young did talk to this, have to have a new contract attached to them, because otherwise an incoming new builder is not going to take it on. And so, in the worst case, there won't be an assignment of existing contracts. It'll be a case of rewriting the deal, which reflects the project on an as-is where-is basis. Okay. So they'll still be completed at some point. I really see, in terms of the opportunities, if they are to flow out of this bun fight at the moment, there's potentially an opportunity for Tier 2 and Tier 3 builders to maybe pick up one or two of these projects, which will be beyond their current comfort zone, but maybe if they can, garner the support of the secured creditors and the developers, they can, get the experience on those Tier 1 jobs, and maybe, provide more choice in terms of the Tier 1 space. Because at the moment, if we keep seeing collapses like this at Tier 1 builders, it's just going to be that'll lead to demand for increased margins, and it's going to make some future projects just that much more expensive.
Well, some people would argue that increased margins are what are needed to take some of the risk out for these poor old subbies that are thrown under the bus. It's because it's so cutthroat, and the margins are so thin, and that's why they've got everything to lose. Mark Young, what are your thoughts when it comes to? I mean, we see these projects. Mark Young, you're probably a little bit too young. Mark Robinson, not quite so sure, but I was around in the late '80s, early '90s, and when we had the recession we had to have. And there were some major collapses of developers. A lot of Japanese property developers pulled out. And I remember particularly at St. Leonard's, there was a massive hole in the ground there for years. And there were a few projects around town. I think in Melbourne it might have been worse, where you had half-built developments. Actually, there were a few in Parramatta that I recall. But they have to get finished off, don't they? I mean, if the thing's half up and the developer's gone, the developer or the builder's gone bust. So, Mark, what do you think that would you imagine, for example, if there's new contractors coming in to pick up these Probuild contracts, are they going back to the subbies that already had the job? Are they tendering out again? How does it work?
Yeah, Nick. So most of those head contracts, I'd say it'd be a good bet to say that they included requirements that the subbies were to be novated across to whoever the developer pleased. Either to the developer or to a new builder. So that side of things probably could be managed, but as Mark Robinson was saying, it's like working out how much those subbies are to be paid, and that's all tied up in part of taking it over the job. And so I think in the most instances, the important trades are going to come in and continue, especially if they're partway through a project and they're at critical stages. Every builder worth their salt will want to keep or use their own trades where they can. So there'll obviously be that part of it in there. The one thing though, I think like we were talking about difficult projects and what happens there, where you might not find a builder who's prepared to come in and take over the risk that the failed building company has left behind. And step into the same risk profile of that builder. When that happens, or if that happens, it probably will, I think not just changing the profit margin. Like profit margin's a big thing, but like this is probably one of the problems with procurement model at the moment, it's sort of like so bottom line with the dollar figure, but not so much about like actually having a good think about where the risk can be shifted and allocated to someone who can better handle the risk. So you might find, project alliance procurement models becoming more popular as opposed to what we've got now, which is the design and construct lump sum turnkey.
So just we're running out of time, but just very quickly tell us what you mean by the project alliance model.
So project alliance model is more of a partnership type arrangement, not in the legal sense, but in the general conceptual sense. So where you have a developer who's good at doing, a certain thing, will take on that part of the risk because they know that they can handle that risk better than the builder, or at least the same, And then everyone in the project alliance all does the same thing, and it's a more realistic look at the way risk works and who can handle it best. That's another way, other than just margins, to manage that risk.
Okay, now look, we're going to wrap up because we are out of time. So this is my warning to anyone who's watching and wants to get a question away. We're slowly wrapping up, but if you get a question in now, then we'll see what we can do for you. I wanted to ask you both, just in closing, imagine what happens with these large builders, that sometimes there's rumours. I get people ringing me all the time with rumours. Oh, have you got any exposure to such and such, or be careful of such and such. And if you've got a subcontractor rings you up, and they've got a lot of their team and equipment and labour force tied up on projects, and they say, listen, there's a rumour going around that this contractor that we've subcontracted to, there's a rumour going around that they've got some issues. What's a good piece of advice you'd have for them? I'd start with you, Mark Young.
Go and do an audit of your contract administration and make sure that where you can fix up any areas where you've not done, notices or whatever it is that you needed to do to ensure that you are doing that. And look downstream to the people you engage and ensure that you've done the same there.
Okay, I guess because otherwise, if you've got Mark Robinson sitting up the top there, he's going to be going through your paperwork pretty tightly. So have a look at your own paperwork, make sure it's in order, and also look downstream so the people that are subcontracting to you and supplying to you are the same. What about you, Mark Robinson? Someone picks up the phone. Listen, I've heard a rumour. Yeah. People are telling me they're running out of cash, and what should I do?
Well, try and secure payment, bring yourself up to date, limit your exposure. And the best way to do that is work out what leverage you've got in terms of the project life cycle. If you're a certification style trade that is required in order to get an occupancy certificate down the track or practical completion, you can then, press that point home that you need to be kept happy, and the way to be kept happy is for payments to be kept up to date.
Okay, all right, good stuff. All right, well, we like happy people, so thank you very much, Mark Young and Mark Robinson, for helping me out with our very first lunch money for 2022. So thank you to all of those who've been watching. We do hope to have this up on iTunes and Google Podcasts and all that sort of stuff later on, so you can listen again, or if that's what you're into. Okay, well, thanks a lot, guys. Take it easy. Nick.